I think that the most important single factor is what you call the growth trajectory. We're still seeing growth in the economy. I think we will continue to see growth in the economy for a while. I think valuations are high, but not unreasonably so. You know, I think that the S&P 500 is selling at roughly 20 times forward earnings. The historic average is 16. You might say it's a little overpriced by that standard. On the other hand, valuations are heavily influenced by interest rates. We have the lowest interest rates we've ever seen. It wouldn't be silly to have the highest valuations we've ever seen, and we don't. So I think it's okay. It's viable.
We always hear buy low, sell high, but you know, you also can hear buy high, sell higher. To your point, if you're bullish equities on a macro level, does that mean you are also sort of making a call that interest rates are going to be low, maybe not forever, but for much longer than many people may think?
Well, number one, I'm bullish on the economy. And I think that stocks won't crap out as long as we have economic growth, number one. And number two...
do you think we will crap out, so to speak?
Eventually. That's why we have cycles. I mean, the market does well, then it does too well, then it gets too high, then it corrects. That's the nature of cycles.
Where are we in that level?
Well, the market is quite high in the sense that it has moved ahead when the economy wasn't. The market started moving ahead March 24th of 2020. And for the next 3 months, we had the worst quarter for GDP in history. So clearly, the market was doing well when the economy wasn't. And that has continued to be somewhat true. So I think it's certainly true that the market is somewhat ahead of itself. When you say I'm bullish, I certainly don't think stocks are cheap. But I think that they're in the band of reasonableness.
And that's the theme here, I think, that we've been in interviews, in panels, by the way, just great to have conversations again in the hallway, which is almost every power player we've talked to, and it sounds like you're in that camp, says, I can make 5 reasons why stocks could or should go down.
Right.
But the reality is, given all the liquidity, given where interest rates are, the consumer, et cetera, they just hold their nose and buy the dip.
And positive economic performance. I think that's right. You know, I think that there's a preoccupation in the media with are you a buyer?
The media, Howard.
Are you a buyer or a seller? And I think that that's too simplistic and it's too black or white, binary. The point is, I think of markets as rich, fair, cheap. And when they're rich, maybe you should sell. When they're cheap, maybe you should buy.
Okay, Tyler's got a question, but we'll call that, hold up, we'll call that the Marx scale now.
Okay.
We're going to make a graphic about this on CNBC, Howard.
Okay.
Where are we?
I think we're in fair territory.
Between fair and rich?
Yes, we might be on the higher part of fair, but in fair territory, there's nothing brilliant to do. That's the key to remember. You know, I said to my son, my last book was on cycles, and I said to my son, I think that my cycle calls have been pretty good over the course of my career. He said, yeah, Dad, that's because you did it 5 times in 50 years. There have been 5 or 6 or 7, maybe I missed a couple, great opportunities to do something. But in between, nothing brilliant to do. Just sit there and be a holder.
Shepard Smith here. Thanks for watching CNBC on YouTube.